For you to be able to be profitable in the market, you actually need to know how to define the Asian range. And the time frame of the Asian range is determined by the highest high and the lowest low between 8 p.m. and New York midnight. 8 p.m. New York and 12 a.m. New York time. That price movement in that time, right, or the range in that time period, right, the purpose of that range sets the stage for potential market moves during the European session, providing traders with a reference point for potential breakouts and reversal when the London session begins, or when the European session actually begins. So when we are trading the market on a day-to-day basis, because when you are actually going into the market, you want to actually utilize something that actually repeats the same thing, right? And if we break above the Asian session high and we are bullish, we use the Asian to look for moves higher, or the Asian session high to look for moves higher, as this indicates institutional buying and sets the stage for a bullish trend. We also look for a confirmation through bullish price action patterns and the presence of buy-side liquidity. And I've already made a video on how to determine your buy-side and sell-side liquidity. But to actually talk a little bit about this, if you are bullish in the current day that you are in, right, you want to look at your previous day's high as your liquidity, your previous month high, your previous week's high, your previous session's high. So if you see a 3-day New York PM session high still open, that is something you wanna fetch as your buy side liquidity. And as you can see in both of these examples that are in these slides, we have our markets here. The red block right here in this market is actually 8 p.m. New York time to midnight New York time. We can see here that the market actually makes or give us our high and low, and then we break above the high. And if we are bullish for that day, right, and we are already above the high, we can actually continue buying because of that high right there. In simple terms, we'll be using that Asian high as our support for that day we're looking to trade in the London or New York session. And conversely, if we break below the Asian low and we are bearish, we use the Asian low to look for movements lower. This indicates institutional selling and sets the stage for a bearish trend, and we look for confirmation through bearish price action pattern and the presence of sell side liquidity. And like I said as well, liquidity can be your previous sessions lows if you are aiming to go lower, your previous session lows, previous days lows, previous week's low, previous month low, and some may say your previous quarter's low as well. And you want to see by that low there, you want to see something like fair value gap, order blocks, or your breakers being left by that low, so that you can look for trades later on in London session or New York session when you're looking to place a trade. And the other thing is you have to understand market sentiment, as understanding market sentiment is crucial. Sometimes when we are bearish, on the other slides we say we want to see us breaking below the Asian low, then we continue lower. But now in this scenario, if we are bearish, we can look for price to take out the highs before seeing a move lower, and this may be known as turtle soup. and we are turtle swooping the Asian highs to actually go and take the Asian low. And you only look for this when you are bearish. It's not like you have to see this sign so that all of a sudden you are bearish. No, you have to have a bearish view of the market, and you see a swoop above your Asian highs, and thereby the Asian highs or above the Asian highs, you need to see your order blocks, your fair value gaps, and whatever PD array you are using to trade to actually continue lower. And if we are bullish, we can look for price to take out the market loss before seeing a move higher. Unlike that other slide, we said we need to see a break above the Asian high, then we continue buying above those Asian highs. Here we are looking at the market taking first the Asian lows, then it goes into some certain order block or some certain fair value gap or OTE, and then we start looking for a move higher below the Asian session low. And this helps us anticipate where the market intends to move next, and we align our trades accordingly. So now if you know that your previous day actually say today has to be a buying day, you can actually say, okay, I want to see the market breaking below the Asian low for us to see our movement higher because there is something below the Asian low, right? Or you can say, I want to see it break above the Asian high so I can look for a London move or a New York move lower to the Asian lows and the other liquidity pools that will be left in the marketplace. Here we have buying conditions and selling conditions. Now, in these two examples right here, I'm showing both where the London goes below the Asian session low and where the London is actually above the Asian session highs, right? So to take advantage of price movement, it's important to actually utilize specific buy conditions in bullish markets. And this is us actually looking for PD arrays in discount for long positions. We use concepts like equilibrium, which means this is the discount and premium, and you want to look for something that says sell in the premium and something that says buy in the discount. Why? Because you are buying discount prices. Like I always say, think about this. You are saying, if the price is cheap, I'm willing to buy cheap prices. That's discount prices. If price is high, I am willing to sell expensive prices. That's premium prices, right? And you'll be using your fair value gaps and your order blocks in the discount to actually find long positions below equilibrium or below your 50% of a price range. You wanna look for your fair value gap, your order blocks, your breakers right in that point, as it provides you with discount or what we may say cheap prices, which actually increase the risk to reward ratio. Now, utilizing sell conditions and to take advantage of price movements, it's important to utilize specific sell conditions, right? And in this slide here, we are actually looking for PD arrays in premium for short position, meaning we are looking for price that is expensive in a range, right? And above 50%, we look for our fair value gaps and order blocks to identify our entry points. For example, we are entering a short position up in the premium zone above 50%. which also increases our risk to reward ratio if we are to put our stop loss above those highs. And if you look at these examples that we have right here, right, we simply go above the Asian high. Looking at the second example that we have here, we go above the Asian high into an order block, into a fair value gap, that is what's above the Asian high. Then we break below the Asian high, creating a fair value gap, right? And we retrace in the New York session in that fair value gap that we created in the London session. Then we see a movement lower throughout the day. And in that other picture, we see a break below the Asian low, and we see that candle that actually broke below the Asian low, creating our fair value gap, and a candle just before that created the order block, right? And we see a movement returning to that in the New York session to provide us our movement lower below sell side liquidity, or your previous day's low, or we can be saying your weekly fair value gap, your daily fair value gap, and all the things like that. So if you like this video, please click that subscribe button, and please make sure that you like the video as it helps us grow. And please leave out your comments in the comment section. Let me know what you learned, let me know what you want me to explain more on this, and let me know what you do not understand so I can explain more on that. But this is all for now. Until next time, good luck and good trading.